Good afternoon. It's March 17, 5:46 p.m., Thursday. Welcome to episode 37. Good afternoon to you, Wawi.
Good afternoon, Mark.
And good afternoon to our listeners. I hope everyone is safe. This is your host, Mark Yu.
Wawi Santos.
And welcome to the Mark Yu and Wawi Show. Disclosure before we proceed, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. For those who have missed it, our previous episode 36, we discussed the weekly market sentiments, inflation, and wage increases, and the roll the clip segment where we highlighted Morgan Stanley interview and Fundstrat's Tom Lee. So on this segment, we're gonna start up for this episode our weekly sentiments and flow segment. So how are the investors and what are their sentiments in the coming days? So according to American Association of Individual Investors, its recent survey, which came out just yesterday, a lot of investors are a lot less bullish compared to the previous week. So at this point in time, bullish sentiment is at 22.5%, down from 24% last week. And people are more bearish. Oops. And people are a little bit more bearish at this point in time. From 45.8%, it increased to 49.8%. Almost 50% of those who have been surveyed thinks that the stock market will be lower, a lot lower in the coming months. For the fear and greed index, investors are still at fear, a little bit better, almost like 10 points better from previous week. We are now at 26, whereas last week we were down at 17. And if you're going to look at the historical figure for fear and greed over time, investors are turning a little bit bullish, but still we're at the down 20s to 30s period or point. For the put call ratio or the options market, we're looking at between 0.9 and 1. So we're still a little low. We're still a little bearish at this point in time compared to average historically. So for those who are still new to the options market, like myself, I don't do options, but I'm kind of familiar with the put call ratio. So put means it's more like a bearish bet, or it's as if you're buying protection or an insurance in case the stock market goes down. Whereas call, you're buying, or at least you're buying options to see or to bet that the stock market would further go up. So at this point in time, we're still at put sentiment or bearish sentiment. For the volatility, for the VIX, this looks at the volatility of the S&P 500. So for the week, for the past 5 days, it's down 13% to 25.67 points. And for the volatility of the NASDAQ, which consists of our large capital or large tech companies, it's also down nearly 14% for the past 5 days, which is interesting because right, Wowie, if I'm not mistaken, the stock market is quite on a downbeat this week.
Well, not in the past 3 days, I think, right? It went
Mhm.
up. After the Fed meeting Wednesday. Oh, yeah, in the past couple of days, it went up
Yes. Yes.
after the Fed meeting. I think they were just waiting for the rate hike.
Mhm.
And and that was my trending factor that I was waiting on. So this just shows, I think, the general sentiment of the investors is that they're, basically bullish for the United States economy. It
Right.
was just set back with current events, with the conflict or war going on between Russia and Ukraine, which is
Yes.
a horrible mess.
Hmm. Yeah. If if I may add to the downtrend, yes. So definitely I saw that coming too. Like Wall Street reacted positively right after Jerome Powell, the Federal Reserve Chairman, said that they're going to raise the Fed funds rate by 0.25% or 25 basis points, which is
Mhm.
very much well expected by the stock market. So as a result, because of this certainty, um, the Wall Street likes it, and as a result, the market bounced back up. But going back, um, for since the start of the year, we're still. You can see the bump there for those who are viewing our YouTube video. You can see the bump going up like a rebound. But since the start of the year, we're still on down end. So Nasdaq, the biggest loser among the three indexes, is down 14%. S&P 500 is down 7.6%, while the Dow Jones Industrials is down negative 5.3%. So if we're going to take a look at some valuations, these are the forward price to earnings ratio, or at least 12 months in advance price in comparison to its expected earnings at that point. So large cap S&P 500, it's trading at 18.2 times its earnings, and it's quite down from its historical range, at least since the pandemic or since the lockdown rally. So since then, since 2020, we were at 20 to 24 times, but now we pierced through the 20 times price to forward earnings, and we're down to 18.2 times. So a little cheaper compared to the past couple of years. But if we are going to take a look at the average of the S&P 500 ratio, average is around 15.97 times. So at 18.2 times, we're still trading at a premium or a little bit expensive compared to its average. And I'm not saying that the market would further go down, but if earnings don't catch up, I would just like to probably summon Morgan Stanley's Mike Wilson when he said fire and ice um, sentiment that he had been, saying since last November, since we've been hitting all-time highs. So ice meaning the cool down of the earnings. So I heard an interview yesterday or the other day that they're seeing more earnings revisions to the downside. Not Morgan Stanley, but some analysts as well. So this is not going to be a good indicator if Wall Street or corporates started trimming down their earnings expectations. What do you think, Bowie? If they keep on, revising their earnings sentiment and valuations are still up, you think you'd agree with me that it might still further come down a little bit in terms of like broader market movements?
Well, that's hard to answer, Mark. I think you have to look at the sector, specific sector.
Right.
I think for the short term, of course, energy,
Mm-hmm.
and then looking a little bit more, uh, maybe for the next few quarters, you should see um, maybe some more improvement in the financial sector.
Mm-hmm.
But
Yes.
analysts will always revise. This is what I'm. This is my thought on it. Most analysts are, their their analysis is somewhat like good for a year, in my opinion.
Right. Like
And
short term.
yeah, so if you're a short-term investor, I think yeah, it would be good to look at those revisions. But if you're a long-term investor, then you would have to look at the macro, events that are happening and those signals and those data that are streaming in.
Right.
It's pretty, I think at this day and age, you could pretty much Google, those data and signals.
Mm-hmm. Well, one of the, like you said, one of the best sectors right now people are looking at is, of course, energy or oil because of the high oil prices and the power of like squeezing more profits into their bottom line. after costs and expenses for sure for big oil companies. And that kind of reflects the sentiment for today, as we're going to take a look at the winners for today. Everybody, each and every sector in the US stock market are the winners today, from energy down to utilities. All of them are up quite a good amount. Energy, of course, is the outperformer at 3.2%, followed by basic materials, healthcare, industrials, real estate. While for the past week, interestingly, for the past week, energy is actually down 3.19%, while financials, like you said, Wowie, it's up big. It's up 5.63% just in this week alone. So after lagging energy since the start of the year, actually, since the start of the year, financials is down 1%. It finally bounced back up big this week. I'm not surprised because given the higher supposedly interest rate moving forward, financials can then squeeze more profit from their operations by hiking up their interest rate, mortgage rate, credit card interest rate, therefore squeezing the consumers, unfortunately, and therefore taking more money to their bottom line, which rewards the shareholders in the end.
Mhm. Yeah, that's true, Mark.
Mhm.
What comes to mind now um, with the near term would be, infrastructure projects. You have to look at, probably roads and bridges that are getting too old, that needing repair. You have to look at those companies that come in to work on those.
Mhm.
Um, I know some of, well, not some, but I guess a lot of our refineries are also needing updating. I think well, I've heard that back in the 80s we had like 300 something refineries, and now we're down to 129.
Mhm.
And I think a lot of them need need uh, need repair. So you're gonna have to look at, who's gonna come in, who's gonna, you know re rebuild that infrastructure, roads, bridges, uh, new refineries.
Mhm.
Um, and aside
More.
from that, yeah,
Mhm.
aside from that, what companies are coming in on the 5G infrastructure?
Right.
So there's a few companies here in Texas that are into that.
Right. So more capital expenditures and more expansion is what you're
That's
seeing, right, Huawei? Mhm.
that's what I'm seeing, because they have the infrastructure budget, that they signed into a bill. So some of that money is gonna go into that.
Right.
And these companies that are building,
Mhm.
they would profit from it, and maybe their shareholders as well.
Totally agree. We need to take a closer look on the infrastructure stocks pretty soon, maybe in next episode. So for
Mhm.
commodities, since the start of the year, you won't believe this, but coal, the enemy, so number one enemy, well, number one enemy is oil, but coal, the dirtiest commodity of them all, I would say, is
Mhm.
has nearly doubled
Mhm.
since the start of the year, followed
Mhm.
by, I would say, gasoline, 43%. And if you're going to look at some other commodities like gold is up 6% since the start of the year.
Mhm.
Silver beat gold. Silver is up 8.9% since the start of the year. What else? Natural gas, 32.6. Western Texas Intermediate or crude oil here in the US is up 37.9%, while gasoline is up 43.3%. So commodities are making a wild comeback this year.
Mhm.
And uh,
Especially metals, right?
yep,
Those
silver.
metals that are ingredients for making batteries
Oh,
are,
like palladium.
I don't know, but I I mean, I'm thinking
Mm-hmm. Oh yeah,
nickel and
nickel.
cobalt. Hmm.
Oh, those two, yes, as well, yes. And for our market performance, we're just gonna highlight a a bunch of them since we already have them in this chart. So we already discussed the S&P 500, the Nasdaq and such. So now we're gonna zoom in some of the outperforming and underperforming stocks and ETFs. So in this graph, the best performing ETF, as I would say, is SARC or short ARC. It's up 37.49% since the start of the year. Whereas if we're gonna compare it to the one that it's shorting, ARC, Kathy Wood's ARC is down negative 35% since the start of the year. So Exxon, which is a purely oil or energy play, it's up 24%. Whereas green energy or Tesla is down 27%. Dollar Tree, which kind of plays into inflation. So as you know, it's as more expensive stuff gets sold, people tend to, in my opinion, try to budget and go to Dollar Tree stores. So it's up
Mm-hmm.
9.89% since the start of the year. TJX, which owns TJ Maxx and I think Home Goods, interestingly, it's down 17.6% since the start of the year, which kind of makes one think like what's going on with TJ Maxx, or it could just be because of the sentiment nowadays that we've been having some issues with this overall sentiment with the stock market, with the overall bearishness. Berkshire Hathaway, which is a plain value, has reached for the first time I saw yesterday. It's Berkshire Class A shares has finally reached the $500,000 mark.
Yes,
Uh,
500,000.
half a
Mhm.
million. If you want to buy a Class A share of Berkshire, it's $500,000 per share. But if you're not, you might want to stick with a Berkshire Class B shares, which is, let's see, how much is it at this point? $345 a share. So,
Well, the way I look at it, if you're buying into, you know, Berk B, it's just like you're buying. This is just my opinion,
mm,
and this is my perspective on it. It's just like you're buying a value ETF.
right.
If
Because
you
of its
buy
components.
because of its components, it's like it's diversified,
Mm,
and a lot of the companies that they have are value companies within Berk B, Berk A.
right.
And with regards to TJ Maxx, and it's kind of stagnant, price valuation, performance,
Mm,
whatever. I think it still has to do with, uh, the question of, are we open, or, or still, I think, in the early process of reopening. And I think we have a handle on the pandemic. I think we have the tools to fight it. I think we know how to deal with it. It's gonna end, well, I pray that it's gonna end up as a like the regular flu.
right.
Uh, uh, Based on what we're seeing, we may see a rise in cases, but we're not seeing as much mortality and morbidity when it comes to COVID-19. So I think we're still in the early stages of reopening, and these value thrift stores or treasure hunting stores like TJ Maxx,
Right.
Ross stores will, finally takes its place uh, once we get a better feel of how we're handling the pandemic situation.
Yeah, pandemic is definitely not yet over. As just the other day, Shenzhen had to be locked down, and some big major Apple companies that supplies their iPhone actually had to slow down their factory output because of that.
Yeah,
So it's
Foxconn
yeah.
in
So
Shenzhen had to lock down.
so I think I saw a news this morning that they kind of opened up like in a bubble like environment, but it's still dampening the output. So that could be a slowdown incoming in the next couple months, but we'll see how that goes. Speaking of Apple, Apple is down. The Apple has the biggest company listed in the stock market. It's down 11.75% since the start of the year. And just to add up some Chinese companies here that made a huge comeback yesterday after China announced interest of solving their problems and improving their corporate governance and supporting their overall stock market. I think Alibaba at one point uh, shot up almost 30 or 40%, including Tencent and JD.com and the rest. But yeah, including despite that kind of performance, outstanding performance since the start of the year, Tencent is still down 16.6%. Alibaba is down 16.6%. Yeah, but we'll take whatever the market gives.
Those two companies are very powerful forces
Mm-hmm.
with increase in gaming and gambling. Tencent should, start taking its foot back on the pedal. Um, I think what the market is seeking is more of an openness from China,
Mm-hmm.
and how investors react. They react with news of suppression, control from the Chinese government.
Mm-hmm.
If you're looking back at what happened with Jack Ma, he just disappeared at one point and now he's
Yeah.
back, but he's kind of muffled. He doesn't say anything.
Yeah, he's silent.
And and I'm you know I'm one of those that see like if your CEO speaks for your company, then the investors' morale increases and they support that company by investing in that company. But
True.
since we haven't heard from Jack Ma in a while, we just don't know what are they doing, what are you planning. So those kind of questions, more disclosure, I think, will
Mm-hmm.
improve money flow into China investment. You can't deny that China is such a big economy and a lot of countries depend on China's production ability.
Mm-hmm.
I think we
Right.
just need China to be more open with their disclosures, like what they're supposedly trying to do right now.
I think yeah, and you can't just ignore, like you said, because they're like considered to be one of the biggest consumer and producer worldwide. So whatever they do matters, and at this point in time, some of their biggest companies are trading at a big discount. So I'm not saying buy the stock since I'm not a registered advisor. I myself, disclosure, I don't have any of those companies at this point in time. I was thinking of buying some of them, but I'm still kind of
Mhm.
like on the side at this point. So yeah.
Same here. Like you, uh, uh, I liquidated my shares of Chinese stocks early on last year because of the problem with disclosures, and it's quite unclear how their business practices are.
Right.
I did hold, just to disclose, I did hold Neo and at one point, and lock in
Lock in coffee.
stock, lock in coffee at one time, and
Yeah.
a few more. But I decided not to hold any more until we see um, how China will be more open with their business disclosures.
Yeah. Hopefully, their words come into fruition because it's definitely a positive tone last or yesterday that they have
Bec-
announced those press release. Mm-hmm.
because if they do, this basically means, that's the only thing, right? If they do, we're gonna see this is just my perspective, we're gonna see a global market
Mm-hmm.
exchange.
Yep.
It it's gonna happen, if we can trust if each of these massive global economies will trust each other,
Mm-hmm.
then we are looking at a global market exchange in the future.
Right. Totally agree. And there'll be more money flowing easily and easier to invest and trust these Chinese companies at least.
And better for the people, I think.
Mm-hmm. So for the weekly fund flows, we take a look at this. This is from Yardeni. It was updated just yesterday, which is a good, data source. So equity fund flows. This is from mutual fund movements. Fund flows, money came out of mutual funds as of yesterday. About $7 billion came out. Well, this is not yesterday, but it was updated yesterday, but it was dated March 9th. So nearly 7 billion came out of the equity mutual funds or stock mutual funds. Whereas if you're going to combine the mutual funds, the stock mutual funds and stock ETFs, looks like the flow into total stock funds, total equity funds is positive 13.2 billion. So the fund flows going into ETFs overpowered the outflows coming out of mutual funds, therefore resulting into 13.2 billion inflows. And bond funds, for both mutual bond funds and ETFs, money came out nearly $12 billion. So some miscellaneous charts here. So this is from Bloomberg. So the 5 to 10-year yield curve inverted again. And this is a sign that possible recession is coming up. This inverted prior to the COVID lockdown or COVID episode that we had. And back then during the mortgage crisis of 0809. So something to watch out for now that we're experiencing an inverted yield curve, even temporarily. And lastly, for our miscellaneous chart of the week, we have again here the financial conditions index. So this index, as it goes up, it means it's getting tighter for people to spend money. So not just the people, but also for institutions, banks, and other non-financial institutions that do their business concerning, lending and borrowing money. So since late, not late last year, but around July last year, the financial conditions index has been going up or has been going tighter. So we're now at negative 0.35. So it's slowly going up there, but we're still in the negative side of things. So still a little bit looser, but getting definitely tighter, if that makes sense. So this is an article that was just published, about a week ago. So the purpose of me sharing this is coming from Janet Yellen, which is the previous Federal Reserve chairman. So according to this Bloomberg article or title, it says Yellen sees uncomfortably high 2022 inflation, but no recession. So she's confident that there's no recession anytime soon. She says that there's a lot of uncertainty, what's going on with Russia and Ukraine. And she does think that that event exacerbates inflation. But according to her, we've got a good, strong economy with an excellent outlook for the labor market and real activity going forward. So that's why she doesn't see any recession coming around soon. Whereas this one, a new article that was just published yesterday, this is in accordance with the current Federal Reserve Chairman Jerome Powell, whereas he doesn't see any recession coming up. So according to him, the American economy is very strong and well positioned to handle tighter monetary policy. So this comes out as he had finally, raised the federal funds rate by 25 basis points, the long-awaited interest rate hike. So we've been talking about it since last year, and finally it has arrived. So it didn't disappoint. Wall Street loves the move. So
I think it could have been higher if not for the Russia-Ukrainian war. In fact, for me, the reaction of the market after the release of that information of the rate hike was surprising for me because the market sentiment moved up.
Yes.
But it's supported by tailwind from news about productivity as well and jobs report.
Right. And some of the ongoing P stocks as well.
Yes,
For the past couple of days. Hopefully something positive comes out of it.
I hope
Um,
so.
so oh, here we go. Here's Tom Lee. Let's play.
Oh,
So we're going to go to the roll the
I
clip segment.
good.
As we were going through our video clip segment to our listeners, I wasn't able to actually find any Tom Lee segment or interview. So this just popped up as a recommended video. So we're gonna take a look at the interview that Tom Lee has given to CNBC. Um, I guess we're just waiting. It's still buffering
Hmm.
at this point in time, but we're gonna hear from the guy who has remained bullish.
And one who has argued after a treacherous
Here we go.
to 2022 that stocks can still have a good year. Fund Strat's Tom Lee is with us now. Welcome back. It's good to see you.
Good to see you, Scott.
Would you admit that you've been too bullish on stocks?
Yes. I'd say that our base case for this first half of this year with stocks would be treacherous, but it's been far worse than we expected. I mean, if I look back at first half 2022, it looks like, as Josh is describing, the market is really bent. I mean, especially economic expectations towards a recession. That was not something we expected. So it's been a far deeper correction than we thought possible, but I don't think the contours of the rest of the year change that much. So I think what's been sort of created as big headwinds, the decision point is going to be if we avoid recession. And I think for a lot of reasons, I don't think the US is actually going to be breaking into a contraction.
I feel like the bullish goalposts, though, have moved, and yet we still want to act as though nothing has really changed for the remainder of the year. I've got a Fed that's still going to be aggressive in trying to get a handle on inflation. I've got earnings which are already trending lower, which are undeniably going to be trending lower. Economy looks like it's slowing. How do I deal with all of that and suggest that stocks can still rise in that kind of an environment? Maybe they can, maybe you'll be right, but how?
Well, I mean, it's part of its perspective. I mean, oil's surged, but at $100 a barrel, that's where we were 2014, for almost 4 or 5 years. And today, on a price per barrel, if you're paying $90 for oil, you're still paying like close to $200 for Diet Coke and $300 for bottled water. So oil's still pretty cheap, and as a burden, it's quite small. And in terms of the Fed the Fed not having a put because they have to tighten, I think it's really going to depend on the path of not only the war, but supply chain glitches. And I know it's a very difficult sort of period for the Fed to navigate, but I think everyone's consensus is making the Fed's turn hawkish, and I don't think that's true. I think they're trying to find appropriate policy, but I do think consensus thinks they're so far behind they have to tighten to create a recession. So that's a really second sort of point of distinction. And the third is, I think there's been a lot of selling recently. I mean, of course, markets can fall for any reason, but I think we're forgetting that these sanctions against oligarchs, that's close to $300 billion of externally managed money that a lot of hedge funds now have to either freeze or redeem. And that's putting a lot of selling pressure on markets, and that's going to abate. So I think a lot of things that we're seeing that look like amplified downside pressure could be transitory.
So he's admitting that he's been a bit more bullish as he would like it. Oh, sorry. I think you're on mute.
Sorry, Mark.
Okay.
I think that was before the Fed rate hike, so it was recorded on March 15.
Uh-huh.
But like he said, you see the contour of the economy to remain relatively the same.
Mhm.
So he's basically saying that we're still on good footing, but he wasn't expecting things to go down as sharply as he saw it.
Right. Well, I think over the long term, he wasn't asked the question if he's still sticking with his picks, but I think he is eventually. He's still holding those stocks. So we're gonna jump on the next interview here. This time it's done by Bloomberg. It's an interview with Charles Schwab, Miss Ann Sonders, entitled Buy Value, Avoid Low Quality Stocks. This interview was also held on the same day as Tom Lee was interviewed, garnered 8,000 views.
Buried in your note is a phrase out of another time and place. A stealth bear market. How stealthy are we in our bear market?
Well, it's less stealthy this year with obviously the NASDAQ 100, Russell 2000 in that more traditional official bear market. But even in the case of the S&P, if you just look at the average member maximum drawdown from a 52-week high, the average across all 500 stocks is minus 25%.
Yeah.
So a lot of the weakness under the surface predated the invasion. It really traced back to the latter part of last year. And I don't think we get out of this mode anytime in the near future unless we get some miraculous ceasefire and beneficial solution in Russia, Ukraine.
For the brave buying today or considering buying, do you stealthily buy the beaten up or do you buy the ones that didn't go down, the small set that stealthily missed the stealth bear market?
I don't know that I would necessarily try to trade around what's worked or what hasn't worked. I think where the leadership has been most consistent in the midst of all the sector volatility and even style volatility to some degree is factors. I spent a lot of time looking at Bloomberg's factors, and the value factors have been pretty consistent leadership factors, even in sectors like tech and consumer discretionary and communication services. So you can screen for the characteristic of value without limiting yourself to the sectors or areas that just happen to live in the value indexes. So I think quality value lowercase v is where I think investors want to focus, and avoiding areas like high volatility, weak balance sheets, non-profitability. I think that low quality trade is largely in the rearview mirror.
Lizanne, we have seen a lot of outflows from equity funds, from riskier debt funds, but how concerned are you that as clients open up their statements and see deep red, they're going to withdraw more and that it will accelerate some of the losses?
I think it depends on what type of an investor you are. If you're an active investor, either you're doing it on your own or you employ active managers, there's been a more level playing field this year. There's more dispersion. There's more, ostensibly, more ability for active to outperform passive. So I think it depends on where your money is. In the passive vehicles, I think if you were in passive vehicles that were more on the high risk end of the spectrum, tied to maybe areas like not just NASDAQ 100, but some of the sort of thematic segments of the market, you're probably in more pain than if you're indexed to some of the safer areas, particularly if you have a diversified portfolio and you've got buffers in other areas. So I don't think there's one simple answer to that.
But it goes exactly where you say the buffers. And but part of the reason why I ask is because the buffers aren't working. And that 60-40 portfolio is seeing a lot of pain. You're seeing bonds and stocks drop together. Is there a new hedge? Or are you saying to clients, look, actually now bonds are a better hedge because they're actually yielding more. And it is a time to rely on them in the traditional way?
Well, I know you guys have on my colleague, Kathy Jones, quite often. She's my counterpart on the fixed income side. And so I'm parroting her and her team's views a little bit, but felt that in the 2 to 2.25 range on the 10-year could be an opportunity to extend duration a little bit. We've had more of a short duration call, but I think you probably bump up around 2.25, that opportunity to extend duration. But you're right, we're in an environment where you have that change in correlation where you're getting hurt both on the equity side and the fixed income side. I think the broader message that might be sending is that we are in more of a secular inflationary backdrop environment, an environment where the US and global economy is more subjected to supply shocks than demand shocks. And really for 30 years until about 2000, you had that negative correlation between bond yields and stock prices, which means positive correlation at the pure price level. So it unquestionably is a trickier environment, but if you take an active strategy in terms of things like duration, it can still add some diversification benefits in a mixed portfolio.
Oof, complicated. Duration, stocks, just in summary, it's what the title said: buy value, avoid low quality stocks. So if you're going to take a look at the company, which we're going to do it in a little bit, you want to take a look at their ability to grow their revenue, ability to generate cash, ability to generate profits, maintain a good balance sheet, and not take a lot of debt in the end.
Yeah, and their ability to sell real product.
Right, a real
So
tangible product
a real
or
tangible
service.
product for one,
Mhm.
and their ability to pivot, like for example, back when we were using, remember those GPS that we were using back in
Garmin,
yeah, look at Garmin, look at how diversified that GPS company has become.
mhm,
And they were all predicting that it was going to be obsolete. So you also look at the value of the company's ability to pivot.
right. It's adaptability for sure.
Mhm.
So this is just an article parroting what we have previously in our charts. It's ARK Investments, which is the profitless investments that it focuses on, except for Tesla. Tesla is profitable at this point in time, but some of which, like Robinhood, some of its investments in the ARK portfolio doesn't generate as much profits as compared to the big tech. So this is an article from Seeking Alpha that was just published this afternoon. Kathy Wood's ARK suffers as 2/3 or 70% of its holdings fell into 1-year lows this week. So who are these companies? 23 stocks in Wood and ARK hold that have plunged to 1-year lows this week. Teladoc, Roku, Zoom, is that Zoom?
Zoom.
Coinbase, Exact Sciences. There's a bunch. Ticker U, is that Unity
Unity.
Software? Unity Software, Twilio, Path, UiPath, Spotify, Beam, Shopify, DraftKings, was Fate,
Fate
Fate
Therapeutics.
Therapeutics, PD, which is PagerDuty, 10 times Genomics, Roblox, Invitae Corporation, Pac B was Pac B.
Biosciences.
Pacific
A lot of them are
Biosciences.
biopharma.
Yeah, Verisight,
Verisight.
C Limited,
That's like Amazon.
DNA, Ginkgo Bioworks,
Twist Biosciences.
Just Biosciences, and Too Simple. All of them, oh, they're right down here. All of them have reached 1-year lows at this point in time. So that's hurting ARK in summary. So now before we go into our last part where we're just going to dissect a company that Huawei had told me about before we started this podcast. This is an article from MarketWatch published just this evening. Rising mortgage rates are no doubt a headwind for housing demand. So for the first time since 2019, mortgage rates now have soared above 4%. Rising rates threaten to pressure home buyers' budgets as the popular spring season for the real estate market gets underway. So more likely there's going to be even more tougher or tighter competition in getting into a property at this point in time. And to add discomfort to that, mortgage rates are now above 4% since 2019. So buyers are going to be pinched more at this point in time, looks like, as this is an article that was just published by Redfin today. Says home prices soar faster to a new high in February. So median sale price, or at least 50% of the houses here in the United States, have increased 16.1% since last year. Now they're at least $389,500 if you're going to buy a house at this point in time. So sold above list, 47%, almost half that's been sold so far this year has, at least sold above their listing price. So be prepared to spend more because of the price list, and also to pay up more on your mortgage payments because of the higher interest. And another article by Redfin published today, housing market update, home prices boast biggest 4-week jump in at least 5 years. So
Yeah, and look out for, changes in the way homes are built. So I think we should foresee smaller square footage, more constructions into like townhome type buildings,
yep.
multi-family dwelling. So we're gonna have to look into how the builders are gonna cope with the increase in building cost.
Right. Smaller yards, smaller square footages. Not enough breathing room for a big family, but doable for a couple, for a starter home. So
Yeah, so
mortgage. Mhm.
so for us Asians, we have seen this happen many years ago. We don't have much land from the country
Right.
we came from, and so builders, they um, accommodated for the lack of land by building high rises.
Right. Buildings.
But in the
Economy.
United States, there's still a lot of land,
Yep.
but with the increase in materials, I would think the logical direction would be, you know, a change in architecture to accommodate and allow for more affordability.
Right. I agree. Somehow there will be common ground where between buyers and sellers they agree at a certain point that they're gonna definitely partake. At this point in time, there's so much demand that I don't think even even higher prices or higher mortgage rates can tamper down the. It might a little bit, but still, people need to live somewhere. So I think it's gonna be definitely eventually there will be a balance, a common ground between them,
There's
between
about
buyers and sellers.
1.7 million new homes being built right now, according to the latest report. It's
Mhm.
not enough, but it shows a good sign that we're still building.
Right. And according to the important survey by Redfin, the home buyer demand index, it's still up 10% since last year. So we haven't seen any drop in demand in buying in terms of home buyer demand, people wanting to buy houses. So now we're gonna talk about a specific company. It's named Walker and Dunlop. So where'd you
Yeah,
heard this company?
yeah,
Wally.
I read it on an article,
Mhm.
and I think Walker and Dunlop, based in Bethesda, Maryland, invest in what I was talking about, multi-dwelling homes,
Mhm.
and also provide capital for
Right.
such developments. They've been around for a long time, but
It's like a lender. Mhm.
yeah, attached to this is a forecast that there will be a surge in refinancing by 2025, but I don't know what it's based on.
Right. So at this
But
point in time,
it would be good to look at this company.
yeah. So we're just gonna take a look at its financials. So the company, its market cap is $4.3 billion. Its current forward price to earnings ratio is 13.7 times. It has a dividend yield of 1.77%. There's not a whole lot, it's a little bit compared to, let's just say, Exxon, which gives like 4%. Disclosure, I don't have Walker and Dunlop in my portfolio. I do have Exxon in my portfolio. Currently, the stock price of Walker and Dunlop is $134.7 a share. If you're going to look at its revenue, its moneymaker as of December, it dipped from 2020, from December 2020 to December 2021. It dipped from 74.3, let's say 74.3, is it millions? This is in millions. Yes, 74.3 million. It dipped to $56.6 million. So that's quite an issue right there. Oh, here we go. Total revenue. So this is the one that we're looking for. So for 2020, they registered 1.037 billion in revenue, whereas in December 2021, a year later, it registered 1.26 or 1.265 billion. So its revenue grew, and its profit from December 2020, 246, it grew to $265 million. So no question, their profit has grown. Their business has also expanded. So we're going to take a look at its balance sheet at this point of time. We're going to take a look specifically at its cash. So cash and equivalents as of December is $305 million. And if you're going to take a look at its total debt is at a little bit up there, $2.7 billion.
Oh,
So company is quite
that's
heavily indebted, but the thing is their business is in lending side. So I'm pretty sure they're
Oh,
using
yeah.
it to their advantage.
Yeah,
So the
good
more debt
catch.
that they could
Yep.
get, that they could use, the more business that they could perform. So we're just going to take a look at its cash flow from operations. A little bit steady over there year over year. And if you're going to look at its free cash flow,
Yeah, I'm seeing 861
yeah.
million.
Mhm. So I'm seeing here negative free cash flow, but looks like over time they have been able to pay down their debt, which is good. Not only on, let's see, this is quarterly, so let's do annual. So that's what's kind of like throwing us off in terms of cash flow numbers. So we're gonna go by what yearly it shows.
Yeah,
So
I quoted
yearly,
the 12 trailing months is what I quoted.
yeah. So for the financing part, they've been able to pay down their debt at least. So in 2021, after taking a bunch of debt in 2020 during the lockdown days, and their free cash flow per share is 27.7. So they're pretty good in terms of their cash flow standing. So pretty good company, as I would say it. So we're gonna compare now its valuations. So forward price to earnings is 13.6 times, whereas half of its peers or competitors is trading at 11.6 times. So it's a little bit more, two times
Pricey.
more, yeah, or at least two multiples more compared to its median, a little bit pricey. Let's gonna take a look at the price to book. It's currently at 2.8 times book value compared to 1.2 on its peers. So a little bit pricey, but I think it's pretty good. Pretty nice and steadily growing, able to repay its debt, nice and steady compared to its peers.
Might be good to watch.
Might be good to add to a watch list portfolio. Oh well, do you have any quote for the week before we end this episode?
Yeah. So I do have a quote today. So this is from Buddhist teaching. So it says, money is numbers and numbers never end. If it takes money to be happy, your search for happiness will never end.
That's pretty deep. So if all you're into is just making money, and then might not make sense in the end because you'll just be finding yourself
Going
probably
around in circles.
yeah. Yep.
So make sure you don't work for money, but let the money work for you.
Right. That's good. That's a good advice right there.
Mhm.
Well, Wowie, thank you so much for coming on this episode. And
Thank you, Mark.
I guess that does it for this episode of Mark You and Wowie Show. Send your questions if you have any, and markyouwowieshow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark You signing out.
Luis Santos signing out.